Global economy is having a hard time getting out of low gear. For the second year in a row, we're starting off on a soft note. Whether it's bad weather or dock strikes in the United States or the closure of big automobile plants that produce the #1 selling vehicle in North America, the United States economy is having a hard time living up to expectations. At the same time, across the world, the Chinese economy continues to slow down as authorities crack down on corruption, and also the housing market comes under stress. All these factors suggest that the global economy is still stuck in low gear. Structural reforms in many emerging market economies, and of course more recently the collapse in oil prices, which has had a very hard knock-on effect on many economies that are producing as opposed to the consumers who ultimately will win off. So the bottom line is we're still stuck in low gear. We're keeping our fingers crossed that the global economy will pick up steam. And here's why. There's around 5 points that should support stronger growth going forward through the remainder of this year and through 2016. First, oil prices have come down, and while they've hurt producing nations and regions and companies, it's a big bonanza for the average person and for businesses who use oil and oil-related products for their inputs. So this is one of the biggest tax cuts we've seen in many years. The second factor would be low interest rates, even lower interest rates than we have experienced in recent years. In the first quarter of 2015, more than 25 central banks have cut rates, and the European Central Bank and the Bank of Japan have also introduced bigger bond buying programs in order to drive interest rates even lower. So lower interest rates means that consumers and businesses can borrow to buy at cheaper rates, and they refinance it at lower cost. Very, very positive development. The third factor are foreign exchange rates have readjusted. Many countries, including Canada, have seen their currencies weaken. This should support stronger exports and earnings of corporations that obviously depend more on shipments abroad, as long as the global economy picks up steam. The fourth point is the stock markets around the world are at record levels. Some of it reflects expectations of improving conditions down the line, but it also rests on the tremendous amount of liquidity that central banks have put into the overall financial system. The fifth point, and probably the most important one in my estimation, is that the U.S. economy is bound to do better. They may be getting off to a sluggish start, but there's a tremendous amount of pent-up demand by U.S. consumers who were really in hibernation for the early stages of this recovery as they deleveraged their own balance sheets. The big job numbers that we've seen over the past year give Americans the confidence to go out there and spend. And we think that that's going to be a very important factor driving the economy's home. And if we're really lucky, we may see many countries around the world adding to infrastructure expenditures. That would be an added bonus to help kickstart global growth around the world. From a Canadian perspective, we obviously have slowed down in terms of our performance from earlier on the recovery phase. The demand for commodities has slowed, and oil in particular, as the global economy has slowed and the oil prices have moved from over $100 a barrel for West Texas down to around 55 barrels here at the end of at the beginning of the second quarter. The bottom line is that we are seeing a rebalancing of economic activity in Canada from the oil and resource producing regions to the manufacturing and service centers that really populate central Canada. This rebalancing should keep our overall economic performance at a relatively even keel despite the weakness that we've seen in Alberta and Newfoundland and Labrador. So the bottom line is it's still a mediocre economic performance, but a lot of factors suggest that we should see some better times ahead.